single day I'm gonna make something great. That's my way.
Hi everybody. I am Ginger Wolf and welcome Stripped Finance. This video is for informational and entertainment purposes only. I am a feature entertainer and stripper, not a financial consultant. Please speak to your financial advisor about any financial matters. And with that out of the way, let's get into the video.
How to begin investing in ETFs. With a multiplicity of platforms available to traders, investing in ETFs has become fairly easy. Follow the steps outlined below to begin investing in ETFs. Find an investing platform. ETFs are available on most online investing platforms, retirement account provider sites, and investing apps like Robinhood. Most of these platforms offer commission-free trading, meaning that you don't have to pay fees to the platform providers to buy or sell ETFs. However, a commission-free purchase or sale does not mean that the ETF provider will also provide access to their product without associated costs. Some areas in which platform services can distinguish their services from others are convenience, services, and product variety. For example, smartphone investing apps enable ETF share purchasing at the tap of a button. This may not be the case for all brokerages, which may ask investors for paperwork or a more complicated situation. Some well-known brokerages, however, offer extensive educational content that helps new investors become familiar with and research ETFs.
Research ETFs. The second and most important step in ETF investing involves researching them. There is a wide variety of ETFs available in the markets today. One thing to remember during the research process is that ETFs are unlike individual securities such as stocks or bonds. You will need to consider the whole picture, in terms of sector or industry, when you commit to an ETF. Here are some questions you might want to consider during the research process. What is your time frame for investing? Are you investing for income or growth? Are there particular sectors or financial instruments that excite you? Consider a trading strategy. If you are a beginning investor in ETFs, dollar cost averaging or spreading out your investment costs over a period of time is a good trading strategy. This is because it smooths out returns over a period of time and ensures a disciplined, as opposed to a haphazard or volatile, approach to investing. It also helps beginning investors learn more about the nuances of ETF investing. When they become more comfortable with trading, investors can move out to more sophisticated strategies like swing trading and sector rotation.
How to buy ETFs. ETFs trade through both online brokers and traditional broker-dealers. You can view some of the top brokers in the industry for ETFs with Investopedia's list of the best brokers for ETFs. You can also typically purchase ETFs in your retirement account. One alternative to standard brokers is a robo-advisor like Betterment and Wealthfront, which make extensive use of ETFs in their investment products. A brokerage account allows investors to trade shares of ETFs just as they would trade shares of stocks. Hands-on investors may opt for a traditional brokerage account, while investors looking to take a more passive approach may opt for a robo-advisor. Robo-advisors often include ETFs in their portfolios, although the choice of whether to focus on ETFs or individual stocks may not be up to the investor. After creating a brokerage account, investors will need to fund that account before investing in ETFs. The exact ways to fund your brokerage account will depend on the broker. After funding your account, you can search for ETFs and make buys and sells in the same way that you would shares of stocks. One of the best ways to narrow your ETF options is to utilize an ETF screening tool. Many brokers offer these tools as a way to sort through the thousands of ETF offerings. You can typically search for ETFs according to some of the following criteria. Volume. Trading volume over a particular period of time allows you to compare the popularity of different funds. The higher the trading volume, the easier it may be to trade that fund. Expenses. The lower the expense ratio, the less of your investment that is given over to administrative costs. While it may be tempting to always search for funds with the lowest expense ratios, sometimes costlier funds, such as actively managed ETFs, have strong enough performance that it more than makes up for the higher fees. Performance: while past performance is not an indication of future returns, this is nonetheless a common metric for comparing ETFs. Holdings: the portfolios of different funds often factor into screener tools as well, allowing customers to compare the different holdings of each possible ETF investment. Commissions: many ETFs are commission-free, meaning that they can be traded without any fees to complete the trade. However, it is worth checking if this is a potential deal breaker.
Examples of popular ETFs below are examples of popular ETFs on the market today. Some ETFs track an index of stocks, thus creating a broad portfolio, while others target specific industries. The SPDR S&P 500 SPY, the SPDR, is the oldest surviving and most widely known ETF that tracks the S&P 500 index. The iShares Russell 2000 IWM tracks the Russell 2000 Small Cap Index. The Invesco QQQ Cubes tracks the Nasdaq 100 Index, which typically contains technology stocks. The SPDR Dow Jones Industrial Average DIA, Diamonds represents the 30 stocks of the Dow Jones Industrial Average. Sector ETFs track individual industries and sectors such as oil (OIH), energy (XLE), financial services (XLF), real estate investment trusts (IYR), and biotechnology (BBH). Commodity ETFs represent commodity markets, including gold (GLD), silver (SLV), crude oil (USO), and natural gas (UNG). Advantages and disadvantages of ETFs. ETFs provide lower average costs because it would be expensive for an investor to buy all the stocks held in an ETF portfolio individually. Investors only need to execute one transaction to buy and one transaction to sell, which leads to fewer broker commissions because there are only a few trades being done by investors. Brokers typically charge a commission for each trade. Some brokers even offer no commission trading on certain low-cost ETFs, reducing costs for investors even further. An ETF's expense ratio is the cost to operate and manage the fund. ETFs typically have low expenses because they track an index. For example, if an ETF tracks the S&P 500 index, it might contain all 500 stocks from the S&P, making it a passively managed fund that is less time-intensive. However, not all ETFs track an index in a passive manner, and may therefore have a higher expense ratio.
Pros: access to many stocks across various industries. Low expense ratios and fewer broker commissions. Risk management through diversification. ETFs exist that focus on targeted industries. Cons: actively managed ETFs have higher fees. Single industry focused ETFs limit diversification. Lack of liquidity hinders transactions. Actively managed ETFs. There are also actively managed ETFs, wherein portfolio managers are more involved in buying and selling shares of companies and changing the holdings within the fund. Typically, a more actively managed fund will have a higher expense ratio than passively managed ETFs. To make sure that an ETF is worth holding, it is important that investors determine how the fund is managed, whether it's actively or passively managed, the resulting expense ratio, and the costs versus the rate of return. Special considerations. Index stock ETFs. An index stock ETF provides investors with a diversification of an index fund as well as the ability to sell short, buy on margin, and purchase as little as one share because there are no minimum deposit requirements. However, not all ETFs are equally diversified. Some may contain a heavy concentration in one industry, or a small group of stocks, or assets that are highly correlated to each other. Dividends and ETFs. Though ETFs provide investors with the ability to gain as stock prices rise and fall, they also benefit from companies that pay dividends. Dividends are a portion of earnings allocated or paid by companies to investors for holding their stock. ETF shareholders are entitled to a proportion of the profits, such as earned interest or dividends paid, and may get a residual value if the fund is liquidated. ETFs and taxes. An ETF is more tax efficient than a mutual fund because most buying and selling occur through an exchange and the ETF sponsor does not need to redeem shares each time an investor wishes to sell or issue new shares each time an investor wishes to buy. Redeeming shares of a fund can trigger a tax liability, so listing the shares on an exchange can keep tax costs lower. In the case of a mutual fund, each time an investor sells their shares, they sell it back to the fund and incur a tax liability that must be paid by the shareholders of the fund. E.T.F.'s market impact. Because ETFs have become increasingly popular with investors, many new funds have been created, resulting in low trading volumes for some of them. The result can lead to investors not being able to easily buy and sell shares of a low volume ETF. Concerns have surfaced about the influence of ETFs on the market and whether demand for these funds can inflate stock values and create fragile bubbles. Some ETFs rely on portfolio models that are untested in different market conditions and can lead to extreme inflows and outflows from the funds, which have a negative impact on market stability. Since the financial crisis, ETFs have played major roles in market flash crashes and instability. Problems with ETFs were significant factors in the flash crashes and market declines in May 2010, August 2015, and February 2018. I hope you have found value in this video. It is because of all of you that Stripped Finance has become so successful. I hope to continue to bring you useful information so you may ask your financial advisor all of the appropriate questions. As always, I am Ginger Wolf. And please like, share and subscribe. I will be back tomorrow with more financial terms stripped down so it is easier for you to understand. Toodles.
Hi guys, this is Ginger Wolf with Financial Independence Tracking, bringing you all of the financial know-how in my big rig. So, don't forget to like, comment, share, and subscribe, and I'll see you next time. Bye!